Well, hello and welcome, everybody. My name is Vern Cushenberry. I'm the Chief Investment Officer here at GoalPath and one of the partners, and I'm back with a quarterly update. I want to do a little check-in on the GoalPath portfolios, talk about performance, talk about some of the design merits and investment philosophy. So let's jump right into it. The agenda for today is I want to touch on the defined outcome system that is GoalPath. As you may recall, GoalPath is bigger than just any single investment. It's designed to create positive outcomes for all retirees. And we define a positive outcome as a paycheck, as an inflation-adjusted income stream. And how we get to that outcome varies by participant, which is why GoalPath is defined as a system rather than a single investment. Notwithstanding, we still need to report on their performance, and we have a fiduciary obligation to adhere to certain investing principles. So I want to be mindful of that and make sure that everybody has the information they need to make good decisions. So I will give a performance update, and then I want to touch briefly on inflation. You know, again, a positive outcome is defined as an inflation-adjusted income stream. And we need to be thinking about whether or not we're seeing significant inflation on the horizon and how we're designing the GoalPath portfolios to protect against that. So by way of, excuse me, just by way of revisiting some of the academic research that supports the GoalPath portfolios, I'm always quick to share this article that was written by Nobel laureate Dr. Robert Merton that undergirds some of the investing philosophy and defines how we seek to build that inflation-adjusted income stream, really hearkening back to the days of defined benefit portfolio. We have the tools to do that inside of a 401k environment today. It's a liability-driven investing approach, and this paper is archived out on our website, and I highly, highly recommend it for anybody that wants to take a little bit of a deeper dive into how we're structuring those portfolios to guard against inflationary environments and then also to deliver that income stream in retirement. Here's a graphic that depicts the system that is GoalPath. The system has three major components. The low-cost target date funds, which is primarily what I'm talking about today. These are a series of collective funds that take the form of a target date fund. We complement that with a focus on retirement income, which is that liability-driven investing approach to creating those portfolios. And then we wrap the whole program in a financial wellness complement that just helps participants engage, comes with a financial coach. There's a system to first answer a lot of questions that people have when they're trying to get into the program. The first challenge is to create a budget and start saving. So in order to reach successful retirement outcomes, we recognize that we have to meet participants, meet employees, wherever they are on the investing lifespan. We have modeled this program after the Department of Labor's tips for fiduciaries. When the DOL wrote this in 2013, and they advised fiduciaries that when they were selecting a QDIA, they consider things like underlying assets, the use of investor data, the glide path appropriate for the plan, fees, expenses, investing types. And in 2013, a lot of these considerations were really cost prohibitive. But here we are in 2021, they're no longer cost prohibitive, and most fiduciaries really have no justification for ignoring some of the features that are available to them out there in the marketplace today. And as you can see, GoalPath stacks up very well against most of the other traditional target date funds. We do have an open architecture approach, which means that we're not subject or forced to just include one single fund family. We can really select from best of breed across all fund families. We can consider data rather than just age, especially with the financial wellness complement. We can consider things like salary, retirement age, Social Security, life expectancy, so on and so forth, which allows us to get much more targeted with those outcomes. Multiple glide paths. The whole program is as little as 12 basis points, and we have a target date fund structure, so it will de-risk your portfolio as you approach retirement. And again, that eliminates one of the major challenges for fiduciaries and plan participants alike, which is selecting from all of these glide paths. You no longer have to have just one glide path, which is, I think of that as, solving for the least common denominator, but rather with a custom approach, we can now include multiple glide paths and meet participants wherever they happen to be along the investing lifespan. So let me get into performance a little bit. And to introduce that conversation, I want to talk a little bit about inflation. And to talk a little bit about inflation, I want to just revisit the history of inflation over the course of the last 100 years. And my trivia question for you all today is, what year in the last century was the worst year to retire? And this graphic here, which I'm going to blow up, will answer that question. So just think to yourself for a moment. Was that 2008, the Great Financial Crisis? Was that 2001, the tech bubble? Was that the Great Depression, the height of the Great Depression, or the peak, the beginning of the Great Depression, 1929 market crash? Which one of those? Any of those jump out? Maybe another environment. So let me jump over here, and I'm going to blow that chart up, and I'm going to show you how to read this here. And if you're a huge nerd like me, you can spend all kinds of time with this because it's really got just incredible data on it. So what we're looking at here is the inflation adjusted return to the S&P 500. I'm using the S&P 500 as a proxy for when was a good year and bad year to retire. That's not perfect, but close enough for this conversation. So to read this chart, we look at, let's say we're looking at 2013 here. The return from 2013 to 2014 is right here, a 30.4% inflation adjusted return. If we wanted to go from 2013 to 2015, we would just pan down an additional, I guess that would be an additional row, and we'd see that the return was 21.3%. That's an annualized number. Those were a couple of good years. 2013 to 2016 would have been 14% annualized. So that's how we read this graphic. Now let's go back and look at 2008 to see what the market did subsequently. And we see that there's a negative 37% return from 2008 to 2009. That probably surprises no one. And then the market's rebounded. You can see we had 1, 2, 3, 4, 5 years of negative returns, and that's on an inflation adjusted basis. And by your 6th year, we were positive again. So I know that felt like sheer panic for a lot of investors that retired in 2008, and especially if you were in a target date fund, just plain vanilla target date fund. That's exactly the experience of someone who was at or near retirement. They added about 5 years onto their working career before they were back to where they were before the Great Financial Crisis. That's what we're trying to protect against, and that's why I'm beginning this video with the introduction of inflation-adjusted returns going back through time. So now let's look at 2001. This would be, this would be the tech bubble right here. If you had retired in 2000 or 2001, you can just kind of count the years. 2000, we had, there's 5 years, there's 10 years, there's 11 years, 12 years, and I got to scroll down a little bit. Looks like, 12 years of negative inflation adjusted returns. So terrible, terrible period of time, 13 years, terrible, terrible period of time to have retired in 2000 as a retiree. You just went 13 years, the first 13 years of your retirement, which are supposed to be what we call the go-go years. You have some money to spend, you're healthy, you're traveling, you're spending money maybe with family, and you entered a period of time where for 13 years in a row, you lost purchasing power. Okay, now let me scan back. I'm just going to skip 1929 for the interest of time, and I'm going to answer the trivia question here. And the answer is 1965, believe it or not, was the worst year to retire in the last 100 years, because in 1965 you were in the decade of the 60s, which wasn't a terrible decade, but very quickly thereafter you had some very severe recessions in the early 70s, and in the late 70s you had an inflationary, maybe hyperinflationary period. So while you made a little bit of money out of the gate, we can count a 17-year period of time where from 1965 to 1982, a retiree actually lost purchasing power on an annualized basis over that period of time. So what's that mean for us? Well, if you go back and you read that article that I referenced by Dr. Robert Merton, Nobel laureate, what that means for us is that we can change the asset allocations inside of our portfolios to make sure that we're delivering an inflation-adjusted income stream. And that inflation-adjusted income stream is produced with Treasury inflation-protected securities. So as inflation starts to creep into our economy, we see the balances of our investment accounts rise in lockstep with that. So let's look at the performance of the GoalPath portfolios in the last couple of years. Like I just mentioned a moment ago, we have 3 glide paths associated with this GoalPath portfolio. We have an aggressive, we have a conservative, and we have a moderate. And we can meet participants, we can meet investors wherever they happen to be and adjust their risk tolerance accordingly. And you can see that just in the last month, the 2020 vintage, the aggressive portfolio was 0.93, the conservative was 1.71, and the moderate was 0.83. Now, typically these will span the horizon. I mean, span the gamut of returns. You see in a bull market, you'll see the aggressive do a little bit better. You'll see the moderate in the middle, and you'll see the conservative lag behind, and those will be flipped in a bear market. Now, in the last month or so, we saw the conservative portfolio really do well, and that has everything to do with interest rates. In the conservative glide path, like I just mentioned, we're using Treasury inflation-protected securities, and those have a tendency to rise as interest rates fall, which is exactly what we saw in the last month. The economy started to slow a little bit, and interest rates that had risen in the first half of the year or first 5 months of the year, they gave a little bit of that back. So in the short run, we can see a little bit of volatility in that conservative glide path, whereas the moderate and the aggressive are really solving for a wealth accumulation goal for participants that might be a little bit behind in their savings. Over the longer run, these portfolios will reach their 3-year track record in December, but over the longer run, what we've been able to show is that the portfolios have done exactly what we would expect them to do. It's been a bear market, it's been a bull market predominantly over the last couple of years, and we see the aggressive do very well in that type of environment. Here we are in 2019 and 2020, and we see the aggressive in the first percentile and third percentile of all target date funds that are in Morningstar's universe. And by and large, these portfolios have fared very well. And again, we would expect them to perform on par with the rest of the industry, depending upon the environment. And I had a question earlier this year from one of our investors asking me to compare the GoalPath funds to Vanguard. So I put this slide together, and you can see that Vanguard's target date fund here is in red, and it compares favorably to the GoalPath moderate. And you can see the statistics down here below. The cost for GoalPath is a little bit higher, and that's on account of the additional choice architecture. You get a conservative and an aggressive glide path along with that. And you also get a wellness complement for an additional 5 basis points or so. Multiple glide paths, income focused, able to customize, open architecture, whereas Vanguard would not offer any of that. So that's the glide path. What about performance? Well, here's what we're really guarding against. This is why I take the time to go back and carefully study the 100-year history of inflation and market panics and sell-offs, because in I guess it would be the great financial crisis, we saw the performance of Vanguard, which you think of as the typical target date fund, was down 34.6%. This is the Vanguard target date 2020. So in 2008, the great financial crisis, you were right there, ready to retire, and your Vanguard target date fund just fell by 30%. That's why I say the typical target date fund added 5 years onto a participant's working career. Look at GoalPath. This is the income focus of GoalPath. We're stress testing it for a similar environment, and you can see that those similar asset allocations were down less than 2%. That's the focus of the GoalPath conservative. So it'll behave a little bit differently in different markets, but that's purposeful. And the purpose is to protect that inflation-adjusted income stream. And then we offer the moderate and aggressive glide paths for participants that want more of a wealth accumulation approach. So that's my update for the quarter. I have additional resources in this PowerPoint that we're looking at here, including asset allocations, and these are all available on our website, in addition to fact sheets, which are made available by our trustee, which is Broadridge Matrix, and additional information on how we create those asset allocations, fund disclosures, and fund audits. So thank you very much. You can also find information on our wellness program that complements this whole initiative, which I won't spend time on today, but you can find more resources on our website. And if you're interested there, reach out to me or my partner, Marco Ungashik. So thanks again. I'll be back in a quarter with another update.